Good morning, everyone. Welcome to Admiral Markets live webinar. My name is Chris, and I'm excited to talk about Fibonacci and waves in this Forex strategy webinar. We're talking about the fibs and the waves as part of a sequel already here, I think the fourth part out of 7. First of all, though, be aware that this webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country or residence, and contact the appropriate entity for more info. Also, please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, as always, of course, be aware of the relevant economic calendar, basically announcements that are coming up, any news events, any unannounced news events, always be aware of that. That could impact the market. You can do that by going to Admiral Markets, clicking on Analytics, going to Forex Calendar, and you'll see a list not only impacting the Forex market, but also CFDs, commodity markets, and the stock indices, of course. One of those big ones are interest rates. We got 2 coming up today, plus some other events. All right, so you can check that out there. Another good thing is to take a look at the analytics and to take a look at market heat map. And you can see the bigger movers of the day yesterday. You can also see regarding currencies, which ones have moved a lot and which ones have shown a lot of momentum. So for instance, there are a couple of currency pairs that move more than 1%. But there are also a couple of currency pairs that didn't move, that went zero, right? No direction, but moved a lot up and down. The pound USD. And a lot of movement up and down, but ultimately only had a small gain. So, or for instance, the Euro New Zealand. It made a lot of ups and downs, but ultimately had a small decline. Whereas the Euro Pound made less movement up and down compared to the Euro New Zealand, but it did fall 1%. So there was more directional movement there. All right. Looking at the market, I want to talk about Fibonacci sequence levels. This time around, we talked about basically retracements and targets, as far as I remember. And now I want to talk about the sequence levels themselves. So, as you probably know what the sequence level is, but just in case, it's 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 3700, 377, 610, 987, etc. So if I didn't make any mistake there. But the idea is to add the 2 numbers, the first 2 numbers, 0 plus 1 is 1. Then you drop the first one and you take the second and third. 1 plus 1 is 2. You keep repeating that. You drop the first one and you take the second and third. 1 plus 2 is 3. So if you keep doing that, you get the sequence levels. 2 plus 3 is 5. Then after that, you get 8. Then you get 13. So it's not really that important, but I just wanted to make sure that we got the basics covered. Now, that is how basically we derive on Fibonacci ratio. So I'm sure we already talked about it. 8 divided by 13 is basically what we get, very close to the 61.8. The further in the sequence, the more closer you get to this level. So ratios is one way, targets is the second way, but a third way is to actually use the sequence levels in counting pips. This is, as far as I'm aware, not something that is very, very often used or referred to. But I am not scanning the market or scanning the internet daily, weekly, or monthly for these things. To be honest, I mean, of course, I learn myself reading some books and learning by experience. But ultimately, I just like to stick to my own tools and sometimes improve, sometimes add, like these fractals, for instance. So maybe it's somewhere on the net, but I think not. The idea is that and this is something I made a indicator for. It's a script to be precise, and it plots the sequence levels automatically on those charts. So let's do that so you can see a visual representation of what I'm meaning. All right, so here we go. The pink and purple lines represent the sequence levels. Those are the Fibonacci sequence levels we just mentioned. However, on an hourly chart, it does not show 1, it does not show 2, and it does not show 3 and 5, because a 5-pip movement, a 1, a 2, a 3, and a 5-pip movement, that means we would have 4 lines clustered at the very top, and it would have no meaning. So I skipped the first ones because they're so close to each other. All right. On the hourly chart, I start with the level of 55. 55 pips here is the first sequence level that is plotted. After that, you get 89. That's the second purple line. Then you get 144, which is the third. Then 233, which is the fourth. Then 377, which is the fifth. So from the pink line to the fifth and last line we see on the chart, the difference is 377 pips. The pink line represents the base, the starting spot. We can count downwards and upwards. That doesn't matter, of course. On a hourly chart and 4-hour chart, this is useful. On a daily chart, it is probably the 55 and the 89 are probably not that useful. It's probably better to start on 144 as the first level and ignore the first two here. On a 50-minute chart, it's different. Actually, in that case, the sequence levels that I use start lower, not on 55, but the first one is already plotted at 13 pips. Now the reason is simple, because on an hourly chart and 4-hour chart, things start to only be interesting if price makes a 55-pip move, let's say. Whereas on a 5-minute chart or 50-minute chart or 30-minute chart, a 13 or 20, 21 or 34-pip move is already more of interest to us as traders. Logically, because we're looking at a smaller time frame, smaller movements have more impact and have more value. So what does this mean? Now, first of all, this Fib script, giving the sequence levels, is something that I developed myself. And if you're watching this webinar, it is free for you. It is something that I don't hand out or send, normally speaking, but as an exception for this webinar, anyone who is watching this, either recording or live, if you send an email to my email right here, then and add, of course, the text that you would like that Fibonacci sequence script, then I'll send that to you for free. So if you haven't done it already, recently I did send out some emails with the script already. So what does it mean? So how can we use it? Now I guess I've explained what it represents or what it shows. How can we use it? Let's stick to this example for the moment. You can see basically how I use it is that if price stays above the third level, it is still in a range. It is still potentially in a corrective zone. Most of the time, the biggest accelerations occur when price breaks the third and heads to the fourth and perhaps then to the fifth. The biggest zones, the biggest impulse could be expected between 3 and 4 and 4 and 5. Sometimes between 5 and 6, especially for big movers, big currency pairs, for instance, that move a lot are pound yen, pound USD, but also, of course, the euro yen, for instance. Those typically move a bit more. They would break the fifth level more regularly and make it to the sixth. Slow movers like the euro dollar or the euro dollar or the odd USD, they sometimes do make it to the sixth, but very, very often they just stop at the fifth and they retrace. All right. Unless there's a big trend going on, of course they can make the sixth too. But basically what my point is that the pound yen will reach the 6th level a lot more regularly than the euro dollar. It's just because it's a bigger mover. So let's take a look at this example. You see price moving from the top, the pink line, hitting the first level, hitting the third level, bouncing off the third, hitting the second, moving to the fourth, bouncing a bit, just shy of the fourth, but still, and then going down to the fifth. So this is a pretty accurate example. Not always will it be this precise. Don't get me wrong. Not always will these levels act as resistance, by the way, like in this case right here. But it does occasionally happen. But it's not part of the part of the reason why I use it. It could sometimes be used as a confluence tool, but it's not the main purpose. All right, the main purpose, from my perspective, is to find the wide open spaces with the trend. All right, so let's see. Now, how do you know where to put the first starting spot, right? How to know to use this as a starting spot and not this, or here, or here? Well, first of all, it's a top. Obviously, it's a top in a downtrend. That's what we want to look for, a top. Second of all, it's a downtrend because I'm using a moving average to indicate what the trend is. It's a 144 EMA close. If you're interested in this special moving average, which indicates different colors, then feel free to write me as well. The moving average is bearish, it's orange, price is below it, so 143 EMA close is indicating it's a downtrend. So I'm looking for downside targets. So I have a top and I have a downside sentiment. Two things. Thirdly, you might wonder, why not take this top? And why take this top? The reason is I'm looking for the top that is at the long-term moving average. So basically, or the top that is the highest top when looking at a reversal. So for instance here, this is a top because below that we were in a downtrend. So this is the highest top, that's clear. In this case, we have a top, but there's a higher top, two higher tops above it. Why would I choose this one? Why would I choose the lower one? Because it's at the moving average. So I always use the one that is at the moving average. Often enough, it's good to use it max 3 times. Why? Because of wave theory. If this is a wave 1, this is a wave 3, this is a wave 5, this Fibonacci sequence levels most of the time should only be used 3 times in a row before there should be a bigger correction. Of course, there could be some extensions possible. True. But roughly speaking, as a rough guideline, be aware of that. So that's why I use this top, because it's at the moving average. And that's why I haven't changed it yet, because here we missed the long-term moving average. So it's still valid. This sequence levels is still valid. If it would have hit the top here, I would have moved it down to that top right there. So now there is a potential for the price to move from 5 to the 6th level. Will it get to the 6th level? Maybe, maybe not. There's no guarantee, first of all, in the market. Second of all, the 6th level is quite far and deep. So what you often see between 5 and 6 is more of a truncated push, and sometimes it misses. It also depends on confluence. This is a tool that's best used just as a discretionary tool, added to analysis. Even could be a good starting point for analysis, but it's not the only thing that I think is sufficient. There has to be something added besides this. But it is a good support tool to understand where the spaces are, where we could expect momentum, where we could expect correction, and yeah, that's it basically, I think. And where we might see continuation, but still a bit more choppy continuation. So let's see. That is one of the reasons why I went short on the euro dollar, not on this account, but on the other account at 106.71.5. On the 50-minute chart, that also had to do with an intraday signal system I'm developing for myself, is right here. Let's see, that arrow is a coincidence. That's not the signal itself. No, I actually, sorry, excuse me, I'm wrong. It's here. This is the signal. This candle was the signal in my intraday system on this candle. All right, but one of the reasons, besides the signal itself, though, of course, was the fact that price had bounced at the fifth level, retraced back to the fourth level, as you can see, was making a correction like this, and was starting to break this trend line. So there were a lot of non-discretionary things that made this setup interesting, besides the, let's say, more automated signal that the system gave me. From a discretionary point of view, I think this made sense too. We could put a fib from here to here. Yesterday we were talking about basically the correction that price, I think price was, when we were looking at it, it was somewhere here. So it was very close to the end, as you can see. Pushed a little bit. Then we got an ABC correction up to the, I was thinking the 38.2 fib, but it went up to the 50, which can happen, a bit of a deeper retracement. A, B, C, and then a continuation. We had some kind of triangle here and a break to the triangle to the downside. So yesterday's analysis, I think more or less did happen. It just took a bit long for this ABC to correct and move down. It takes some time. But you can see why when price was here yesterday in our live webinar, it was not so interesting to short. If anything, reversal traders could have been on the lookout for a bounce. I'm not much of a reversal trader, so I don't really hunt for that much. But Nennet is better in that than myself. He has also some reversal systems he is testing himself. I prefer looking for these types of setups myself, where I'm trading with the trend. In any case, these sequence levels help a bit understand not only that this is a good maybe breakout from 5 to 6, but also help understand potential for price to accelerate between these levels right there. But that was unfortunately before our webinar yesterday. Now the zones get bigger and bigger, as you can see, as the Fibonacci sequence levels go further. So you can see it almost like a snowman, right? It's a winter theme, so, and that's because basically as price starts to accelerate, you'll get bigger and bigger zones. Of course, eventually, price will show divergence and there will be a bigger correction, and the correction will most likely go back to the long-term moving average. That is the goal, the target of that correction. When there is divergence, well, on a lower than hourly chart, right, lower than hourly chart, a single divergence is often not enough. On an hourly, it's a toss-up, it's a 4-hour, it's often enough. On a lower than hourly chart, you often need double divergence before price moves up back to the long-term moving average. But that said, that is the standard target for divergence. Of course, it could break further if it is a reversal. So this is how the market works. It moves away from the moving average, and then it runs out of breath, it runs out of steam, and it goes back to the moving average. That's it, especially the Forex market. Other markets, there's a different mechanism, right? Stock market, I think, is less elastic like this. From my personal perspective, it seems more like there's a continuous push. There's not that much back and forth. All right, now, not to say there's no volatility, but I have a feeling that there is more move from the moving average and back to the moving average in the Forex market. That's just my humble opinion here. But in any case, this fib sequence level helps us understand where we could expect the acceleration away from the moving average And the divergence is then giving us a warning when we might want to be careful and when we could expect price to go back to those moving averages. All right, let's look at the hourly chart here. Any questions, by the way, in the meantime? Let me get rid of my email address here. It's kind of blocking our screen. Now, in this case, the hourly starting spot is the same as the 50-minute spot. That's coincidence, yeah, because there's a fractal at the long-term moving average on the hourly chart, the same spot as the 50-minute chart. So that's just pure coincidence. Before that, I would have used this top, but now we have a top at the moving average, so I use this one. And it's below. It's a top below the moving average, right? Here is a top above the moving average. So at that point, when price was still here, I would have used this top. So let's do that first. Sorry. Right there. And it's okay to use both. It's okay to use first this one and then this one to see the different levels. As you can see here, we broke through the third, so there could be a good acceleration down to the fourth. We are in the impulsive part if you start from the top. That's good. So there could be some acceleration. If we use, let's put a line there to mark where that fourth level is and where the fifth level is. Because we'll lose it when we do the tool again from the top here. And let's see what it says. 1, 2, this is the third level. All right, so we should expect the most acceleration below 106 probably. 106 down to 105.20, then to 105.50. Those are the best zones because it's going from the fourth to the fifth, and from one sequence level, and from 3 to 4 on the other. And here's the fifth. So this is where we have the most space. Split into various parts. Here, here, and here. If it gets there, of course. Let's see. All right, so now from an hourly perspective, we were only at level 2 and level 1, so there was not very much interesting going on from this particular spot. If we would have used the top, we know that we could have been breaking the third, so that would have been more interesting, right? So that's something to note. This is just, once again, an extra tool that helps identify spaces. More importantly, regarding entry would be, of course, your system, your methods. From my perspective yesterday, I was saying, watch out for these two fibs, but it went to the 50. There are 2 wicks at the 50. That could have been one way of tackling entries, of course. The engulfing twins here, or the break like I did. How, of course, this particular space, the trade is entered to the downside, is dependent on your system. But at least it shows you, these sequence levels show the space, what kind of acceleration we can expect and when. So it's a supportive tool for targets and holding on, trade management, holding on to the trades. When is it good? When is it not good? It might be not so good moment to hold on to the trade too long when price is still up in here, the first 2 levels, but when it's breaking below the third, it could be more interesting, right? To try to catch a bigger reward to risk, try to catch a bigger profitable trade. Remember that a very well-known slogan is let your winners run, cut your losses short, right? Now that sounds easy. Unfortunately, not many traders actually give any advice how to do that. Sounds simple, but it's tough in practice. This Fibonacci sequence tool is great for letting the winners run and understanding when that could be wise and when that might not be wise. So it's very useful for that first equation. Cutting your losses short can be done with my time pattern rule. So I have 2 specific tools that address both of those issues. and I'm a big fan of both, and they help me understand when to stay in or when to exit. So this is how I personally tackle that equation, that slogan, in a practical way, not just verbally, but in real actions. The Fib sequence tool is one of those. So let's see. Will it get down to 106? Time will tell. But I think that there's a good downtrend going on here, and so there seems to be a decent chance of that. What else? The pound dollar, for instance, yesterday, right? Let me just add one tool here. Okay. And let's take the sequence levels from the top. All right. 1, 2, 3. Now, in this case, the acceleration between 3 and 4 and 4 and 5 was not that big. It was a bit slower between 3 and 4. Actually, a very strong move between 1 and 3. So, you know, there are exceptions. This is just a general rule. These things can happen. But still, the space between 3 and 4 and 4 and 5 was completed. Now, one note though, as you can see, price did miss 5, the fifth level, just by a tad. So once again, this is not something that is supposed to be ultra precise. It is just a rough indication. And this is an example. Fib levels work with the same. They are general zones, not super precise to the pip, to the tenth of a pip precise levels. However, that said, it was one of the reasons why I was still expecting a bear flag and one more break to get to that fifth level and also to get divergence. So I personally was still looking for a bear flag and one more slight, small little continuation before getting the ABC zigzag. All right, now that did not happen. And ultimately, maybe I was a bit too, too precise about those last 15 pips here. But I also knew that I also warned you for a V-Valley return, that if price were to push really, really strong here, don't look for shorts anymore because then it's a V-Valley turnaround. Now, the reason I told you that is because I knew that it is relatively close. So it has already made 5 waves down, and there is that potential for price then, and it has hit the minus 272 target, by the way. So there is that chance of a bounce and reversal. I did not trade it. I'm not a big reversal fan, but yeah, this was one that worked out very neatly. If you are, if you like those types of trades. Now, since it hit the moving average, right? I can now move the fib again to that particular high. And what does that mean? That means price is at the first level. What does that mean? The price needs to break below the third level before there's a good chance of a nice impulse towards the fourth. And if it breaks the fourth, down to the fifth. That means from a bearish perspective, price would need to break below S1 and 124 before we can see some good acceleration to the downside. Now, from a wave perspective, I'll start adding some waves slowly but surely. We know that this is completed 5 waves. So either this is going to make an ABC, or we might even see a reversal, and this could be a 1, 2, 3, 4, 5 for a bigger 1 or a bigger A. But in any case, this momentum is indicating bullishness. So what could happen is that price might stop at the pivot point, might stop at the S1 and bounce like this. In that case, we would probably, in that case, put the sequence levels at that bottom. We can put it underneath this bottom, but the problem is Sorry, we could put it under this bottom, of course. First of all, sorry. And what do we see? At this moment, price is around the moving average. So it makes sense to look at both sides. That's possible. We see price broke above the third, in fact. So yeah, there is a good chance that it might get up to the fourth and then to the fifth if it breaks above those levels. So one thing to do is to keep an eye on a breakout like this, and there could be that potential up to the fourth, and if it breaks above R1, up to the fifth, perhaps, right? So that's from a sequence point of view. From a fib and wave perspective, I'm keeping an eye between you and me here. I personally am keeping an eye on the 38.2 fib here and pivot point around 124.70. And that could be a bouncing spot in my view. And also the 50 fib could be a bouncing spot. If it bounces at those shallow fibs, especially the 38.2 fib, then this is probably a wave 4, and price will make a wave 5 at the fourth level. There I would expect some correction again, and then a continuation up to the fifth level. So this is tying in those fib sequences with waves and fibs. But let's see if price bounces at the pivot point, at the 38.2, at the 124.70. If it does and it breaks this resistance, then that could happen. If it doesn't, it starts to break below. Oh, sorry. Starts to break below the 50 fib. And then in that case, there could be some moves to the downside here. All right. So, any questions from a fib sequence point of view? Anything you would like to clarify? In the meantime, let me show you your odd, for instance. This has pushed a lot, right? So we don't see any tops at the long-term moving average, do we? So then we'll just use the highest top on this chart, right? You don't have to scroll back to see where's the highest one, you know. You can just use the most recent one that you see on this chart. You don't have to go back in time, of course, right? So on the Eurod, we'll just use the top that's above the moving average, but that's okay because there's no top at the long-term moving average. And we see that price broke the third. We see moved down to the fourth, and now it's moving down to the fifth. And we saw also a pretty strong move even between the second and third. So it's good even to keep an eye on all these levels, right? All five of them. And you even see some impulses between two and third. But from my experience, the most happens between 3 and 4 and 5. Now, by coincidence, we saw two examples in a row where we saw the most between 2 and 3, and a bit less between 3 and 4. Actually, but okay, never mind. That's just from my perspective, experience, just random or exceptions, I should say. But sometimes it happens. Sometimes you get accelerations at different spots. Also, this is pretty fast, by the way. Those are just a few couple of candles before you hit the target. All right. The fifth level is pretty close by, but has not been hit yet. One of the reasons why I also took on a different account a Euro odd short is the fact that we had a break here. There was a correction at the fourth level, still a downside target left at the fifth. We got a break. This was, in my opinion, a pullback for continuation. So we had a break of this trend line as well. The entry entry I took was this candle, this one. Clear break below that trend line is the one I shorted. So that trade is going well. So if we look at, yeah, good point, divergence. Eagles is mentioning the divergence here, and that's true. That's a very good point. That's why it's always good to keep an eye on these fib sequence levels. It's good to keep an eye on time factor, and it's good to keep an eye on divergence. Indeed, exactly. So it's a good channel, but this low on the oscillator is weak. So on the hourly chart, a single divergence is a toss-up. On a 4-hour chart, it's often strong enough just to hold as is. Sometimes you have, even on a 4-hour chart, of course, double divergence, but it's typically stronger. An hourly chart is a toss-up. So I would say at this point, it seems pretty likely we'll get a break of this bottom in the S1. Then we should see double divergence. And at probably around this level, we should see a bounce. That would be the main target from my perspective. But we can look at, of course, other things as well when making that analysis. Let's see. Yeah, there is a minus 61.8 target there. Minus 272 target. So it seems pretty likely. You can check other time frames here. Yeah, so 123.10-ish, 139, excuse me, could be a level where we could see an ABC zigzag back to the long-term moving average. That target is just a rough idea. Once again, not always will that target get hit. It might miss it by a bit, but there is a decent chance of an ABC zigzag at that level. All right, we didn't talk about the pound yen yet. We talked about a potential bounce on the pound yen at the 78.6 fib at 138.25. Price just missed that, hit only 138.50. Now, I personally was expecting that last bit of a move on the pound yen too, just like the pound dollar, but it didn't happen. What I did say was look for a bear flag for the last move. We didn't get a bear flag on the hourly chart. This is already around this point. We could already seriously doubt that that would be a bear flag and whether this is becoming a zigzag. And we got a zigzag to the upside. So yeah, this particular fib just missed a bit. That sometimes happens. I would be okay with considering that a hit. It's a small difference. Sorry. Uh, problem is that it could still be open. So that's a bit of a question mark there. That's a bit annoying. But we can take a look at this fib. Minus 272 target has been hit. So I think it's probably best to look at the internal structure of this up move. And there could be reasons to look at a 5-wave up. In that case, it is probably over and we'll probably not break this bottom. All right, so from that perspective, if it did complete 5 waves up, it might make an ABC zigzag here and bounce at one of these deeper fibs to make a move up like this. Now, from a fib sequence point of view, 1, 2, 3, 4, 5. Almost reached the 6th level. So yeah, that's another reason why there's a chance it just can make a retracement back to that long-term moving average. And if we use the most recent bottom, which is this, we see 1, 2, 3 above the 3rd. So if it does bounce at the pivot point, for instance, there's a good chance it could get up to the 5th. It doesn't have to be the 3rd, it could be these levels too, to the 5th. So that's something we'll find out soon enough. If it breaks, let's see, if it breaks below this bottom, of course, in that case, this ABC zigzag is not happening. It doesn't have to be an ABC zigzag necessarily, but it could be the start of one. That depends on higher time frames. We'd have to analyze what seems more likely. If this is momentum and this is a correction, then the hook back could give cause for a pretty sturdy move up there. But yeah, let's see. That's the current, I think, currently the most likely wave analysis I see. Alrighty, that's Fib sequences for today. Any questions that you have maybe that you would like to look at? In the meantime, of course, feel free to take a look at our analysis, analytics, fundamental, technical waves. This is an example of technicals yesterday from Nenet looking at the dollar CAD. He was warning for a head and shoulders there. Also more webinars, of course, tonight. Nenet takes a look at money management. Tomorrow we take a look at how spreads impact your trading. And next week we're back with the usual lineup. So I hope to see you then. Regarding the strategy webinar, that's all, by the way, once more, you can find at admiralmarkets.com. Go to education and click on Forex and CFD webinars. Regarding the sequence, once again, if you're interested in the script itself, feel free to write me here an email to get that script. I would highly recommend it. I think it's probably, well, definitely ranked in the my top 3. I think it's very, very powerful, so I would definitely recommend it. Regarding the rest of the strategy webinars, next week I do finally want to dive into more waves. I'm going to take it step by step, so don't worry if you're scared of waves. There's no need to be scared. I want to actually make it in such a way that it is practical and not too theoretical. And I want to discuss ways how to use waves for practical purposes, not to start to make it a very large and theoretical debate, more practical focused. All right. Thanks so much for being here. Appreciate that, and wish you great trading and a great day, folks. Talk to you soon. Cheers.